Hey there, good afternoon, everybody. My name is Chuck Mattiucci, Senior Vice President and Financial Advisor with Fort Pitt Capital Group. Thank you for joining us today for this webinar focusing on life insurance, joined here by my guest, Ed Powell. I'll get a little bit into Ed's background in a minute, but Ed, thank you for joining us today for this webinar.
Thanks, Ed. Good morning, everybody. Thanks, Chuck.
So, getting started, just a little bit of background on Fort Pitt Capital Group. If you're not one of our clients or you don't know about our firm, wanted to just focus on a couple of key things that we do here at Fort Pitt. For one, we help our clients with investment management and financial planning. A few things that make us unique to compared to some other firms in the same industry is that we have a boutique type feel, smaller company type feel. However, we have all the resources of the much larger firms out there. We're also really focused on continually providing a very high level of client service. If you're working with us as a client, you'll have a advisor team that handles all of the client service needs, and those things are really important to us. And last but not least is our in-house investment management team. So all of the investments that we offer and provide to our clients are done in-house through our portfolio management team. So those are just some of the things that make Fort Pitt unique. Again, if you're not a client of ours currently and interested in getting some more information, please feel free to reach out to us, and we'd be happy to tell you a little bit more about how we can work with you and help you reach all your financial goals. So a little bit about our webinars. We do these webinars every couple of weeks, really focusing on a number of different topics, all related to financial planning. We house all of these webinars on our website, so folks can go there and view them on demand. And we also obviously will give you information about upcoming webinars that you can join, or again, you go to our website and view the past webinars. So prior to the end of the presentation today, I'll tell you a little bit about some of the other webinars that we have upcoming. So a little bit about myself. It's always fun to talk about yourself, right? I, as an advisor, work with individuals and families, again, mainly just focusing on building a plan for those clients to help them reach all of their financial goals. Outside of work, I have 3 young daughters, so I don't have much time to do much beyond hanging out with them and again, work. But in my free time, I like to get outdoors, love to play golf, work out, those kinds of things. So a little bit about our guest today, Ed Powell. So Ed has been in the insurance industry for over 10 years. Ed graduated from Cal University with a bachelor's in business administration. Currently, Ed is the vice president of sales with Exchange Underwriters. So, I've worked with Ed a lot in the past, and wanted to have him join us here today on this webinar to talk a little bit more about life insurance. So, Ed, again, thanks for being with us. We appreciate it.
I appreciate it. That leaves out that I have 3 kids at home too, so I'm in the same boat with everybody. Yeah, lots of sports and activities outside of the office. So.
Right, exactly. So yeah, you feel my pain there with that. Yeah. So let's talk a little bit about how you can interact during the webinar. So depending on what type of device that you're on, whether you're on your phone or your computer, you'll have 2 different views. So first, with the phone or tablet, you'll see on the screen here, there's an area at the bottom where you can click to ask questions if you want to ask a question during the presentation. And there's also an area for handouts as well. So if you want to ask a question, just click on that icon down there, and your question will go to us, and we'll try our best to answer that question before the end of our time here today. If you're on a computer, it looks a little bit different here. As you can see, you can still click to ask questions or to get handouts. It's just a little bit of a different view. You'll see here at the top, that arrow will pop out, that taskbar, if you will, that will allow you to again ask questions and access the handouts. Okay. So with that being handled, let's start by talking about what we're going to discuss with you folks here today. So if you could let me know by raising your hand, how many people out there knew that September was Life Insurance Awareness Month? Okay, so Ed knew. Obviously, I'm sure there's a lot of folks out there with their hands raised. But yeah, so September is Life Insurance Awareness Month. So we thought it would be a good idea to cover this topic today. Life insurance can be a really complicated topic, and there's many different aspects of life insurance that can be covered. So what we wanted to do today is kind of keep it high level and talk about the most common use of life insurance, which is essentially to provide a death benefit to someone's beneficiaries. So we will kind of keep it high level and focusing on that. And then we also thought that the best way to handle this is to talk to you about what you want to hear. So many of you had sent in some questions prior to the webinar here today. So we will handle those questions and address those questions. And then we'll also start with a little bit of kind of just basics in regards to life insurance, how it works, and those types of things. Also, as I mentioned earlier, you can ask questions during the presentation. If we don't have time to answer your question, rest assured we have everybody's contact information, so we will follow up with you after the webinar to make sure that we answer your particular question and get you the information that you need for that. Okay, so let's just start with a basic definition of life insurance. So life insurance basically can be defined as a contract between an insurance company and a policyholder. So essentially, the policyholder is applying for a life insurance policy, and based on what type of life insurance it is and the different aspects, the death benefit, etc., the life insurance company will pay out a benefit, and the policyholder then, in exchange for that benefit, will pay a premium either on a monthly or annual basis. So that's very general, very basic as far as the life insurance definition. Again, there's many different types and many different ways that you can go with it, but that's the basic structure of life insurance. So there's two main types of life insurance that we primarily deal with our clients, and I think Ed, probably same with you and your clients, and that would be term insurance and whole or permanent life insurance. So defining term insurance first, essentially with term insurance, you have a benefit, again, provided by the life insurance company, a death benefit, but it's only for a certain term or a certain period of time. Usually, most common is a 10, a 15, or 20-year term is what we see most commonly. Term insurance a lot of times is referred to as pure insurance. So kind of similar to your homeowner's insurance or your automobile insurance. It's basically, if you don't have an event that requires that insurance benefit to kick in, then you really don't get anything out of it. So you're essentially just paying the premiums for that event that may or may not happen in the future over that certain term. Whole life insurance is a little bit different. So again, it's often referred to as permanent life insurance because whole life insurance lasts a policyholder's whole life, or sometimes it can be for a specified term, but it's different than your standard term insurance because Again, in most cases, it lasts for somebody's whole life. And in addition to that, there are some features in whole life insurance, such as cash value and things like that. So if the insurance isn't used or something along those lines, there are other aspects to the policy, such as the cash value that can be tapped into. In both cases, term or whole life insurance, the amount of premium that a policyholder pays is based off of your age, your health, and your life expectancy. So those factors come into play when dealing with premiums. Somebody who has a terminal illness or high blood pressure or is on certain medications may have higher premiums than somebody who doesn't have those same characteristics. So it is based on those types of things. A lot of times as well, policyholders will have to go through what's called underwriting to see what they'll qualify for as far as the premium goes. So that can include a medical examination and things like that to determine what your premium amount will be. So that gives you kind of a general brief overview of the different types of life insurance that we're going to talk about here today. I think it is important to mention that no matter what, we always think it's important to meet with an insurance professional or your financial advisor to determine if you have enough life insurance or if you have a life insurance need, and then you can kind of determine to where to go from there. So a lot of times when I'm meeting with clients, we're talking about their specific situation and are they underinsured? Do they need more insurance, or maybe they don't need life insurance at all and they have a policy that they're paying for, but they really don't need it. So it's definitely important to have that evaluated by a professional, to make sure that you're in whatever is the best policy or situation for you. So with that kind of background, general information getting covered, Ed, why don't we kind of jump into the questions and start addressing some of the questions that you all have provided to us. I will start with this question here, which is asking how to best use life insurance for financial planning. First I would say that I think life insurance is a crucial component of any financial plan. Again, whether you are short in the amount of life insurance that you need or you don't need any life insurance at all, it's definitely an important component to at least evaluate to make sure that you have the appropriate coverage. Depending on someone's unique situation, and generally speaking, life insurance most often is used to replace someone's income, to pay off debt, to replace future retirement savings and those types of things. So, when we sit down with a client and analyze insurance, we're looking at, and the most basic way that you can look at it is, God forbid, what if something happened to you and you were to pass? What do we need to do to ensure that your family and beneficiaries can maintain their same level of lifestyle moving forward? So that's how we kind of really evaluate the life insurance need and really make recommendations from that. So move to the second question, Ed. I think you were going to handle this one. Sure. This deals with what's referred to as return of premium life insurance.
Sure. Yeah. So question says just states return of premium life insurance. So return of premium is a type of term life insurance policy, and essentially what it does is it acts as a term policy in that if you were to pass away during the term of that policy, it's going to pay out its death benefit. But the return of premium portion adds a feature to that policy, whereas if you outlive that term, 10-year term, 20-year term, whatever it might be, At the end of that policy term, the insurance company will return all of the premiums paid to you. So it's pretty simple. It's a nice little feature. There's a couple little caveats to it. Obviously, it's relative to a straightforward term policy, it's going to have a little bit higher premium to it. For the simple fact that the insurance companies, they got to make money some way or another. So what they do is they take a little bit more premium from you. They're going to earn some money on that, knowing that at the end of the term, they're going to give that money back to you at the end. So, I mean, it's definitely a good option if you can afford a little bit more premium and you do need some temporary protection, whatever that may be for a mortgage or something of the nature, and you can afford a little bit more, it's nice to add that in, knowing you'll get it back on the back end.
Right.
Yeah.
Yeah, and I think that's a common theme that you'll see with life insurance policies in general is there's all of these additional features that you can add to these policies, and of course these additional features come with additional fees and premiums that you'll incur. So again, that's where it's really important to have a review of your specific situation to see what different options may be necessary
Sure.
for the individual client. So
yeah,
thanks, Ed. Okay, next question I will take. This one was a little bit specific. Basically, the question says that this particular person is 56 years old. They have a 30-year term policy, and they are wondering if they should let the policy expire when it hits the 30-year mark or renew it after that. And they mentioned renewing it at exorbitant rates. So that brings up a good point. With insurance, we talked about a few minutes ago, with life insurance, your premiums are based on your health and the underwriting that goes into that. So, and your life expectancy. So as you get older, generally speaking, your premiums will get more expensive just because your life expectancy is shorter, and with age sometimes come different risk factors and things like that. So a lot of times what we see is these term policies, whether it be 10, 15, 20 years, 30 years, when they expire, if somebody wants to keep them or keep the same type of policy, the premiums will be significantly higher than what they were when you initially started that policy. So I think that's important to point out. But focusing on this particular question, again, it's very case specific. But again, generally speaking, if you're at the age of 56 and you don't have a significant need still for life insurance, then in most cases, I would say it probably makes sense to just not renew that policy, or to not pay those high premiums. And when I say significant need, that would mean your mortgage is paid off. If you have any dependents, they're self-sufficient and maybe out of the home and financially independent. If you have enough savings and retirement savings that your surviving spouse, if you're married, is able to maintain their standard of living if you were to pass. If you check the box on all of those things, then you really don't have what we would consider a significant need to continue that coverage. Now, again, it's always very case specific. So, but generally speaking, if you're in that situation where all of those things don't apply to you any longer, then not having that policy in place and paying that premium would not be or would be advisable at that point.
I'll make a note just on that briefly. So just using that age specific, it sounds like the person's coming to the end of their term and they need to decide what to do. At 56, there would still be options available. If they only needed another 10 years, maybe to get them to age 65 or 66, rather than paying the exorbitant amount of money it would be to keep that other policy in place, they could look to go to underwriting again and maybe just get a short 10-year term policy. And maybe that's something you can afford to get you to your retirement age. On the contrary, if there's maybe health issues involved now, you got that policy 30 years ago, and maybe if there is health issues, maybe it makes sense to keep your current one and pay a little bit higher rate to get you through a certain period of time.
Right.
So
yeah, no, that's a great point. If for instance in this situation, maybe the mortgage isn't quite paid off yet, or you have a couple more years before your youngest child is out of the
it gets
out
through
of the
college
nest.
or whatever it might be. Sure.
Right. Yeah, maybe a shorter term or something like that would be appropriate. So yeah, again, it's really case specific, but again, generally speaking, if those needs aren't something that you're concerned with at that point, then you have some options there. So thanks, Ed.
Yeah.
Appreciate that. So if we move on to the next question here.
This one's me, right?
This
Yep.
one's you. Yeah, this is focusing on nursing homes, I believe.
Yeah, so the question just sort of states, do nursing homes take life insurance policies? I'll have to talk in some general terms and then try to get a little bit specific, but life insurance policies can have long-term care or accelerated death benefit riders. So those would be the two options. If your life insurance policy happens to have one of those things or riders, it is possible that the nursing home, you could use whether it's cash value or you could use death benefit early to pay for things like a nursing home or in-home care, or maybe if you had a terminal illness, you can accelerate your death benefit to get it early. Those are typically available in whole life or permanent life insurance policies. Right. So chances are that you would probably know, I mean, that also comes at a cost.
Right.
And it's usually illustrated when that life insurance proposal is presented. So you'd probably know if you had that option available, because on the contrary, like a very standard term life insurance policy is not going to have that option available. So if you just bought a term policy to cover debt and mortgage, and happened to get a long 30-year window, and then you got to a position where you needed to go to a home, that life insurance policy, that's only for a death benefit only. There's not going to be any riders involved there. So again, it's going to be somewhat case specific. It's possible. Chances are, if you have a life policy and you don't know it's in there, it's probably not.
Right.
But it's something that can be reviewed with an illustration. You can order an illustration on your life insurance and have an advisor look at it and let you know.
Right.
Yep.
Right. Yeah. Again, just kind of going back to all the different kind of features or options that you can add to these policies. So it is a good question, and again, if you're talking specifically about a policy that you have, you would definitely want to have your advisor or insurance professional take a look at that to see what all the different benefits that policy has. Okay, so moving on to the next question, and I'll take this one. This question is focused on using life insurance when making decisions on pension elections. So this is a really good question, and this is something that I know personally in dealing with my clients, I've encountered several times. But basically, what this means, or what we really look at when electing a pension benefit, is usually pension benefits offer different types of payouts. So you can have what's called a single life payout. You can have a joint survivor payout, and those can be at different levels. So a single life payout is essentially, if it's my pension, I retire and I elect the single life pension, then I will get whatever the pension benefit amount is for my lifetime. If I pass after 2 or 3 years, nobody gets anything else beyond that point. And in most cases, that is usually the highest benefit amount, the single life. Then there's also options for a joint survivor option, which a lot of times is 75% or 50%. So in that case, in a joint survivor 75% situation, if I pass, my surviving spouse wouldn't get the full pension. They would get 75% of what the pension amount was. And then same thing with 50%. The surviving spouse would get 50% of the benefit. So what we really look at is, to try and maximize the pension. If you have life insurance in place, does it make sense to not pick a survivor option and just go with the single life, knowing that when you pass, that life insurance benefit is going to be paid to your surviving spouse? So it won't really matter that they're not going to get the pension, because they'll get the benefit from the life insurance. But it really becomes kind of a math problem there, because you really need to look at, okay, what is the difference between the single life pension option and the survivor option, and then look at what is the benefit, the death benefit of the life insurance policy, and kind of calculate at different periods of time, will you be ahead if you forego the survivor option and use just have the life insurance policy kick in at some point. So, but essentially what we would do is run a calculation on that and really be able to come back to the client with, hard numbers to say, here is what this will look like, and this is the best option, for you. So that's a great question, and that is definitely, something that we encounter a lot. And our job is to really just try and provide all that information to the client so they can make an informed decision on what's best for them. So
makes sense.
Moving on to the next question, Ed, I think you were going to handle this one too. This is talking a little bit about whole life and borrowing from it.
Yeah, so as it states here, just says whole life and borrowing from it. So it's certainly possible and actually pretty common to borrow cash against a permanent life insurance policy. There's a bunch of good advantages to it too, if it's a possibility. There's some nice features. So for one, there aren't any loan requirements like there would be in a traditional loan. So they're not going to run credit or anything of that nature for you to be allowed access to borrow that money. The funds can be used for anything at all. So there's no, why are you taking this money out kind of deal. I mean, whatever you might need them for, you can do, and they can also be paid back at any time. So whenever you take a loan out against the cash value of your life insurance, there's not a set date, hey, you have to pay this back in 5, 10 years, whatever it might be. You can hold on to that forever and actually use the death benefit itself to pay back the loan. So there's a lot of nice flexibility there. And then also the rates tend to be really good compared to, typical market rates for loans. So you get, low interest rates to borrow against. And now it's obviously your cash in there essentially because you've been paying into this. So the amount that you can borrow is going to be subject to how much cash value is in the policy. And then, there might be some other terms and conditions within the policy, but a lot of good features. And again, if you have a need, it's definitely a good avenue. Just like any loan, though, you would want to be careful to make sure that you could at very least afford interest payments on them. Right. Because if you do, you have to at least pay interest. And if you're not able to do that, or if you missed interest payments, you could lose the policy, all the cash value in it, and the whole intention of having it in the first place. So a lot of good features from it. It's, again, definitely possible. Just depends on how much cash you have in there and what the scenarios are. But just like any loan, got to make sure you're diligent and setting it up for success. So
sure,
yeah.
And again, too, and we, I've encountered situations like this before with clients that need some cash for whatever to fund a project at your house or something like that, and it's not uncommon that somebody says, well, what about this whole life insurance that I have? I have this, cash value from there. Can I just use that? So, it's definitely something that, we talk with our clients about. So, again, depending on your specific situation, you definitely want to sit down with your advisor or insurance professional and see what makes the most sense for you. But it's definitely something that, if you have a whole life policy that has cash value, it's there and it's available. Just have to determine if it makes the most sense for you.
Yeah, and again, you're going to want to go back and run a current illustration. So talk to your advisor and or life insurance agent, have them order an illustration. That'll give you how much cash is in there and the most up-to-date terms and conditions for everything.
Yep.
Yep.
Great. Awesome. Thank you.
One more for me, I believe, right here.
Yeah.
So the next one I'll go on. It reads, if you have a variable life insurance for 20 years, can this be converted to term? So again, generally speaking, life insurance policies can have convertibility options in them. I would say most commonly a term life insurance policy at the end of its life can have an option to convert to whole life. I mean, there's a bunch of different policies and setups, so we've already mentioned that a few times on how, on all the different ways and options that can be added, but trying to answer how this one's worded, because it sounds like somebody has a variable life insurance policy that they're looking to do something with. Typically, those variable life insurance policies need a certain amount of cash and a certain amount of market gains to keep them funded.
Right.
So you have to pay into those, keep those alive through funds, and hopefully have help from the market to keep those going. Typically, those are not going to have a convertibility option to go sort of, I don't want to say backwards, but to a more simple kind of policy,
right?
Like a term policy. So I would say if it's variable, the chances are would be real low for any sort of convertibility. But again, possible. So you'd need to order your illustrations and see what options are in there to determine if it's possible or not.
Right.
Yeah.
Right. Yeah. So yeah, I mean, there are again a number of different options and features with different policies. So yeah, definitely a good question. So I wanted to circle back on a question. There were a couple similar questions that I kind of just would think I can just combine them into one answer. But essentially asking about the coverage amount needed at different ages. I know I'm getting a little redundant by saying this, but it is very case specific. That being said, speaking in general terms, I think one of the questions here that came through was a situation where this individual is 65 years old and has no debt. Do they need life insurance? Again, generally speaking, if you have no debt, you don't have any dependents, you have enough funds or retirement income for you if you were to pass and you have a surviving spouse or any family members that you need to take care of. Generally speaking, you probably don't. And again, at age 65, the premiums that you may have to pay, even for a term policy, are probably fairly significant. So in that particular situation, without knowing anything else, I would say, you probably don't have a need for life insurance. For somebody who's in their 50s or 40s, again, depending on their particular situation, you may need life insurance. What we do, and I don't know if you've probably done these before as well, Ed, but in evaluating an insurance need for a particular client, we'll do a lot of times what's called a insurance gap analysis. So if somebody has, say, a $500,000, 20-year term policy, and they have, 3 kids, they have, a mortgage that still has, 20 years left on it, their spouse doesn't work, and, that they would need to replace their income. We kind of run all of those factors into our financial planning software and come up with a report that shows, you have $500,000 in life insurance right now, but what you would actually need to replace, your income and pay off debts and all those other things is actually, $2 million, just throwing out
Sure.
a generic number there. So, that's something that's really helpful because we can put your specific criteria into the software and then, kind of at the end come out with a number of what, how much coverage you really need. So that's something that we do periodically for folks to kind of help determine that.
Yeah, that makes sense.
One of the other questions that we had, and a lot of people ask about this, is how are life insurance proceeds taxed, or are they taxed? And it's a good question. And again, generally speaking, life insurance proceeds, wouldn't be taxed to the person, the beneficiary that receives those dollars, if you will. There's a caveat to that, though, because it depends. There can be some situations where life insurance proceeds can be taxed. So, for instance, if somebody doesn't directly take a payout from a policy right away, and they allow that policy or that benefit to kind of sit there and accrue interest or other type of growth, that growth and interest could be taxable. But in most situations, that death benefit is not taxable, which is a reason why a lot of people like to have life insurance to pass on that death benefit to their beneficiaries tax-free.
Mm-hmm. Yeah.
So I don't know if that was pretty much all of the questions that we had prior to the webinar. That I think we pretty much hit on everything. I didn't see anything else that had come through. So again, I hope that we were able to kind of cover, at least from a high level, some of the questions that you folks had, and provide some answers to those. Again, I think most importantly, no matter what your situation is, the best thing to do is to sit down with an advisor or an insurance professional to evaluate your specific situation and your specific needs to make sure that you have the appropriate amount of coverage, or maybe you have a policy that you don't need, those types of things. But those are things that Ed and I do on a daily basis with our clients, and we'd be happy to help anybody make that evaluation as well. So. Anything else, Ed, that you wanted to add?
No, I appreciate the time. It's nice spending some time with you today, Chuck.
Yeah, absolutely.
And everybody's time today out there. Yeah, I mean, a lot of this stuff, we say general a lot, and it does get a little bit interesting sometimes, but I think either of us would be the individual basis. Those individual reviews is really the way to determine what you have or what you need. So whether that's, going back to somebody right now, or something you have right now, or reaching out to somebody new, I just advise, you got to get in front of somebody.
Sure. Yeah. I mean, these products can be really complicated, so it's best to sit down with a professional that can make sure that that you have what's right for you. So with that being said, a couple other quick things that I wanted to cover before we wrap up. So we do have a few upcoming webinars in the next couple of weeks. As you can see here on the screen, our next webinar is Wednesday, September 21st, focusing on ESOPs and is an ESOP right for your particular business. And the next webinar after that is actually a two-part, split into two different sessions, titled How to Ace All 4 Life Stages of Financial Planning. So part 1 is on Thursday, October 6th, and then part 2 is on Wednesday, October the 12th. So we encourage you folks, if you have interest in any of those topics, to definitely tune in and join us for that. And also keep an eye out for any other future webinars that we have. We'll definitely get those out to you, and would love to have you attend those in the future. So again, thank you for your time. Really appreciate everybody's questions. And again, if there was a question that we weren't able to get to, or if somebody has a question afterwards, we will be sure to follow up with you and get you an answer for those questions. And with that, we will end it there. Thanks again. I hope everybody has a great Wednesday afternoon.